Now we want to talk about the model determining the exchange rate. The very first model we want to talk about is the law of one price. This model tells us the same good in different competitive markets must sell for the same price when transportation costs and trade barrier between those markets are not important. So why that is the case? Well, you can think about pizza store across the street and which is also across the border. So you can imagine that in the US, that Canada and US are very close and there is no natural barriers for trade. And then it's possible that one side of the street is belong to US and the other side belong to Canada. Let's imagine that. If that is the case, think about the pizza that produced in both sides of the street. Then if the pizza prices is $5 each and in Canada is $5 each, then if the exchange rate for $1 it's going to get 1.1 Canadian dollar, then people will choose not to buy the pizza from the US side. That is because if you buy pizza from the US side, in Canadian dollars perspective, each $1 will be able to get 1.1 Canadian dollar. So as a Canadian, when you want to buy US pizza, you need to pay 5.5 Canadian dollar. However, when you buy pizza at the Canadian side, you only need to pay 5 Canadian dollar. Therefore, as a rational individual, you will choose to buy more of the Canadian pizza instead of the US pizza. For an American, what they think is that when I buy pizza in the US side is $5. But then given that when I buy the pizza from the Canadian side, when I exchange for the Canadian dollar, I'm going to get 5.5 Canadian dollar, which means that I can get one pizza. In addition to that, I probably can also get a cup of cola. Therefore, I would prefer to buy goods from the Canadian side because it's much cheaper. Because of that, there are more demand for the Canadian size pizza, less demand for the US size pizza. What happened is that the Canadian pizza will become more expensive and the US pizza will become less expensive. So what happened is that eventually this arbitrage will stop when people find out that it doesn't make any difference to buy pizza from the US side versus the Canadian side. In that situation, it must be the case that the Canadian pizza need to be 5.5 Canadian dollar. That is because if the pizza is less than 5.5 Canadian dollar, then there will always be a lot of demand from the US side to buy pizza from the Canadian side. So this is an example of the law of one price. That is, same good, which is pizza in this case, in a different competitive market that is across the street. One is in the US market, the other is in the Canadian market. They must sell for the same price when the transportation costs and the trade barrier between those two markets are not important. In our example, they are across street, so the transportation costs and the trade barrier are not at all important, and then they have to be sold at the same price. Otherwise, the demand for the relative cheap goods will become higher, and then eventually it will drive up the price of the low price side, and then eventually the price of both sides will be exactly the same. So to wrap up the discussion related to the law of one price, we can write it down in the following formula. We said that the price of US will equal to the exchange rate of the US versus Canadian dollar, then multiplied by the price of the Canadian goods. So in here, the P is the price of a goods, and then it will tell us that the goods after adjusting the currency value should be of the same price, and that is about the law of one price. So then now we want to talk about an application of the law of one price, and that is called the purchasing power parity. The purchasing power parity tells us that the price of all goods or services or a representative group of goods, for example, a basket across country, should be the same. And then it predicts that the people in all countries have the same purchasing power with their currency. That is, we no longer talk about the price of a goods, but we are talking about the price of a basket. Given that we know the CPI is measuring the price of a basket of goods in a country and see how does the price change over time. Therefore, in fact, we can use the CPI as an index to represent the level of the average price of a country, and then use the concept of the law of one price to come up with the purchasing power parity. Then we are going to have the following formula. We said that the price of the US will equal to the exchange rate multiplied by the price of Canada. In here, the exchange rate is how many units of US dollar you are going to get per units of the Canadian dollar. Then under this example, you will see that the price in here refer to the level of the average price. On the left-hand side of the equation is the level of the average price in the US, and on the right-hand side is the level of the average price for Canada. Differ from the law of one price, the P in here refer only to the price of a goods for US and Canada. So that's the main difference between the law of one price and the purchasing power parity. For the law of one price, it emphasizes that a particular goods in a competitive market need to have the same price after adjusting the exchange rate. But for the purchasing power parity, it is about the level of average price or a representative group of goods that they need to of the same price after adjusting the exchange rate. And based on this formula, we can further derive the equation that tell us what the exchange rate value should be. That is, if this equation holds, then we can rearrange the equation, and then we are going to get the exchange rate, which is the US dollar per unit of the Canadian dollar, need to be equal the price level of the US, or the average price of the US, divided by the average price of Canada. So this is the general formula that we can use to tell us what should be the right exchange rate. Because of that, we have two versions of that. One is called the absolute purchasing power parity. The other is called the relative purchasing power parity. The absolute purchasing power parity use exactly this formula in here. Therefore, the currency value will be the relative price or the price ratio of the two countries. So the purchasing power parity not only tell us that the goods or the same basket of goods need to sell at the same price at different countries, but it further can help us come up with the exchange rate. That is, the exchange rate should represent the relative price of a same basket of goods in the two countries. Therefore, here comes a famous example that people adopt this concept to come up with the exchange rate, which is called Big Mac Index. So what is Big Mac? Well, that is the hamburger sold by McDonald's. They have 100% beef patty. It has the shredded lettuce. They have a Big Mac sauce, and then they have the American cheese, pickle slice, and onions. So the ingredients inside the Big Macs are exactly the same across all countries. So then, if the absolute purchasing power parity can imply an exchange rate, we can use the price of Big Macs sold across countries to come up with the exchange rate. And that is exactly what the Economist, a journal that did to think about exchange rate in 1986. So now let's look at what is the implied exchange rate of a US dollar in NT dollar implied by the Big Mac's index? Well, let's look at the web, and then we see that the Big Mac in Taiwan sells for $80 for the simplest one, and in US it sells for $3.19. So if we have the 80 divided by 3.19, we are going to get something around 25. Therefore, it tells us that the Big Mac's index tells us that the exchange rate of the NT dollar per US dollar need to be about 25. And what should be the exchange rate nowadays? That in the Bank of Taiwan, it stated that the exchange rate is about 27 to 28. In other words, the Big Mac index implies that the exchange rate need to be 25, but nowadays the exchange rate is about 27 to 28. Therefore, we know that the NT dollar is somehow a little bit be undervalued. That is because the Big Mac index tells us one US dollar is only worth about 25 NT dollar, but in reality it is sold for $27. So that is the interesting application of the absolute purchasing power parity. Now let's move on to talk about another concept, the relative purchasing power parity. The relative purchasing power parity not only focuses on the exact level of the price of the average price, it's now about the changes of the price. And so we call it the relative PPP instead of the absolute PPP. The reason why we need the concept of relative PPP is because a lot of time when we want to adopt the absolute PPP, we use the price of a basket of goods, and that basket will be the price of the CPI, that is the Consumer Price Index, and which is about the price of a basket of goods that generally consumed in a country. But then there comes the problem, that is when we are computing the CPI, there is a base year for all the countries. When the value is in the base year, the CPI will always equal 100. Therefore, for this case, that Canada and US chooses the same year as the base year, if we adopt the CPI to come up with the exchange rate that we think that should be, then it will always equal 1. But that is not the case. Therefore, to resolve this issue, we come up with the concept of the relative PPP. In formula, the relative purchasing power parity tells us that the changes in the exchange rate, that is the exchange rate at time t minus the exchange rate at time t minus 1 divided by the exchange rate at the time t minus 1 will exactly equal to the inflation rate of the US minus the inflation rate of Canada at time t, because the inflation rate at time t tell us what does the price got changed from this period, that is time t, from time t plus 1. Therefore, the changes in the exchange rate need to be equal the changes in the price. And that is the other formula that people use to predict the exchange rate. It claims that the changes in the nominal exchange rate between two countries equal to the difference in the inflation rate between the two countries. It sounds great that we can use either the absolute PPP or relative PPP to tell us what should be the right exchange rate, if it should be right. But is that so? Of course, that is not the case. So there are some shortcomings for the PPP. So what are the shortcomings of PPP, which means that why in reality a lot of time the purchasing power parity doesn't hold? The first reason is because when we are talking about the law of one price, we say that the market is competitive, we say the trade cost is not important, the transportation cost is not important. But in fact, in the reality, trade barrier exists and there are non-tradable goods. Inside the consumption basket, it includes not only the tradable goods, but the non-tradable goods. Because of that, it makes the purchasing power parity computed based on the CPI that does not hold, because not all the goods inside the basket of CPI is tradable goods, and there may exist trade barriers to make the exist price differences across countries. So that is about the shortcomings of the PPP, that is, the purchasing power parity may not hold across countries. The second thing is related to our assumption, that is, it's possible that the markets are not perfect. So that is imperfect markets. That is, there exist price differences across countries to maximize profit due to different consumer preferences. For example, in Asia, people prefer red. They think that if you see red, it means happiness, it means something good. In the Western cultures, that green means something good, so then they use the green to represent something happy. Therefore, when they produce a product, for example, if you sell a green hat in Asia, people will not want to buy it, so it has to be sold at a low price. In the Western culture, that the green means good. So for example, in St. Patrick's Day, people wear green hats. But in Asia, people don't like that. So then the green hat will be sold at a higher price in the Western culture than the Asian cultures. Because of that, people have different preferences for goods. And so the goods will be sold at different price. The last problem is related to CPI. We know that the CPI is developed based on a survey on the typical consumption basket of a household in a country. The survey is conducted differently across countries. Therefore, the basket of the goods, in fact, across country may be different. Because of that, when you use the CPI to come up with the implied exchange rate, it may be different because you are comparing apple with oranges. So the CPI sounds perfect for computing the exchange rate that based on the purchasing power parity. But in fact, in practice, they are not a good process because the basket can be different across countries. So here we complete the discussion related to the purchasing power parity.